Did the laws on business associations change recently? Breaking news for business owners and entrepreneurs. The question on everyone's minds right now is, did the laws on business associations change recently? If you are navigating the world of business, these updates are crucial for your planning and tax strategies. Just recently, significant changes were made with the enactment of the One Big Beautiful Bill Act, signed into law on July 4, 2025. This legislation introduces several tax reforms that directly affect private companies, partnerships, Scorporations, and Ccorporations. One of the key updates is the permanent 20% deduction for qualified business income under Section 199A. This change benefits partnerships, Scorporations, and sole proprietorships. The income thresholds for phase-outs have increased to $75,000 for non-joint returns and $150,000 for joint returns. This is a notable increase from previous thresholds, impacting how business owners plan their tax strategies. Another important change is the restoration of the ability for businesses to immediately expense 100% of the cost of qualified property. This applies to property acquired and placed in service after January 19, 2025. This reversal enhances first-year bonus depreciation rules for eligible assets, including those used in manufacturing. Additionally, Section 179 expensing limits have been raised. Businesses can now write off up to $2,500,000 of eligible assets placed in service in 2025. The phase-out begins at $4 million of asset purchases, with adjustments for inflation starting in 2026. For Ccorporations, changes to the qualified small business stock rules were made. The threshold for qualifying as qualified small business stock has increased from $50 million to $75 million in aggregate gross assets. This amount will also be adjusted for inflation starting in 2027. The holding period for capital gain exclusion has been phased down from 5 years to as few as 3 years for partial exclusions. Moreover, the One Big Beautiful Bill Act reversed certain international tax provisions related to controlled foreign corporations. This affects multinational business associations and their United States shareholders. Limitations on downward attribution of stock ownership have been reinstated to prevent unintended tax inclusions. Overall, these recent legal changes primarily focus on tax provisions that impact the structure, taxation, and planning strategies of business associations. Business owners and legal advisors should carefully consider these updates when managing their business associations in 2025 and beyond.